In the early 2000s, when Wall Street was throwing champagne parties and home prices were rising faster than salaries, one economist was quietly warning that it would all come crashing down. He wasn't a celebrity investor or a billionaire banker. He was a professor at NYU, Nouriel Roubini. And back then, few people listened to him. But when the financial world imploded in 2008, his name became impossible to ignore. Roubini earned the nickname Dr. Doom, not because he loved pessimism, but because he said the things no one wanted to hear. While others praised the new era of stable growth and financial innovation, he argued that the economy was sitting on a mountain of unsustainable debt, and that one small tremor could bring it all down. Let's rewind to 2006. The U.S. housing market was booming. Everyone from Wall Street executives to first-time buyers believed home prices could only go up. Mortgages were being handed out to anyone who could sign their name, even people with no income or job. These risky loans, known as subprime mortgages, were bundled together into complex financial products called mortgage-backed securities. To investors, they looked safe, AAA rated, supposedly as solid as government bonds. It was financial engineering at its most dangerous. Banks were leveraging these securities to borrow more, make more bets, and inflate their profits. It was a system addicted to debt dressed up as innovation. That year, Roubini stood before the International Monetary Fund and warned that the U.S. housing bubble was about to burst. He predicted that falling home prices would trigger a chain reaction, first hitting homeowners, then banks, and eventually the entire global economy. The reaction? Laughter. Many in the audience couldn't believe it. The stock market was booming, unemployment was low, and credit was flowing freely. Even top economists dismissed Roubini's warnings as overly dramatic. But he had done his homework. He saw that American consumers were drowning in debt. He saw that banks were using borrowed money to make even riskier bets. And he understood the psychology of bubbles. When people start believing that prices will rise forever, that's exactly when the fall begins. By 2007, the cracks started to show. Home prices flattened. Defaults surged. The value of mortgage-backed securities began to collapse. And soon, the very institutions that had built their fortunes on these products were in trouble. Then came 2008. Lehman Brothers collapsed. AIG needed a massive bailout. Credit markets froze overnight. Trillions of dollars in wealth vanished in months. And suddenly, the economist they mocked became the one they quoted. Roubini's prediction had come true almost exactly as he described. But he wasn't celebrating. He was warning again. Because to him, the 2008 crash wasn't a one-off disaster. It was a symptom of a deeper problem, a global economy addicted to cheap credit and short-term thinking. He called it the age of debt. Governments borrowed heavily to bail out banks. Central banks slashed interest rates to near zero to stimulate recovery. And while that worked in the short run, it created a new problem. It made money cheap again. Investors, desperate for returns, began pouring cash into stocks, tech startups, and later cryptocurrencies. Roubini warned that these low rates and easy money policies would eventually fuel the next bubble, not in housing this time, but across entire asset classes. Fast forward to today, and his words feel prophetic once again. Rising inflation has forced central banks to raise rates aggressively, shaking markets worldwide. Debt levels from governments to households are at historic highs. Asset prices from real estate to tech stocks are wobbling under the pressure. It's a reminder of the same old cycle: euphoria, leverage, denial, collapse. Roubini once said, "Economic crises are like earthquakes. You can't predict the exact moment, but you can see the fault lines." And if history is any guide, those fault lines are forming again. Because the real lesson of 2008 was that not one man predicted a crash, it's that almost no one listened. And in finance, ignoring the pessimists can sometimes be the most expensive mistake of all.